Hello and welcome to an FX Times daily video recap. I'm CMS Forex market analyst Nick Nassad. Today's Thursday, November 19, 2009. The euro and other higher yielding currencies declined against the dollar and yen in today's trading as riskier assets fell out of favor on concerns about the slow pace at which the world economy is exiting the recession. We had some slumping equities in Asian and European trading, and commodity prices were down as well, which pushed investors back into the US and Japanese currencies. US stocks were down as well, but as we look at the euro-dollar pair, we do see that we have found some support around 1.4850, and then the euro has actually managed to win back some of its earlier losses. There was also some increased risk aversion as several countries, and overnight notably Brazil and South Korea, were two that took steps to help local firms better manage foreign exchange risks. Indonesia earlier this week considered some capital controls to help quell depreciation of its currency, and this is beginning to be a theme as the very low dollar and the very low yuan are hurting local economy, especially those that are reliant on exports. But mainly, currency markets were driven by the weak performance in stocks. And if we look at the euro-dollar pair, though, we did remain within our established range that we've seen throughout most of November between 1.48 and around 1.50, though we didn't actually reach any of those support or resistance boundaries. We also had some mixed US data, which I will get to shortly. Here we're looking at the US dollar Japanese yen pair with 30-minute candles, and we see that the yen was a strong performer overnight. Here too we're establishing a bit of a range with support drawn connecting these three lows and resistance at around this level here. Now we broke through an important support early in the week around 89.50, which goes back to the lows connecting from November 1st and November 11th. So we're seeing the yen holding on to these gains below the 89.50 level now. Now let's take a look at some fundamentals. In the US, we saw jobless claims for the week ending November 14th remain steady at 505,000, which was the same level we had the previous week. Continuing claims, meanwhile, fell down to 5.61 million. The 4-week moving average fell by 6.5 thousand to 514,000, is now at its lowest level since November 22nd, 2008. So even though initial claims still remain high enough that the labor market will likely lose jobs overall this month, though economists are now looking for the figure to dip below the 500,000 level as a sign that the economy may begin to start adding jobs. A second report, the Philly Fed Manufacturing Index, saw its General Business Activity Index rise to 16.7 for the month of November, a figure that was better than expected and was led by higher new orders and shipments, and it showed its Employment Index almost going to neutral at negative 0.5. So this is the fourth month in a row that the Philly Fed has been above zero, and we can see that on our chart here is our zero level. And now we're approaching the 20 area, so this is the highest level we've seen since going back to July 07. And if you can see, the gray here is industrial production, and the trend here has been sloping upward, where we had 3 months of rather good industrial production prior to October. Finally, we had the Conference Board Leading Economic Indicators Index, which for October rose 0.3%, the 7th straight month of increase, though the figure was smaller than expected. 6 of the 10 leading indicators increased, with the most positive being the interest rate spread, the inverted trend in jobless claims, and stock prices. On the downside, we had lower consumer expectations and building permits. So overall, we had relatively good labor market data, an improved manufacturing report, but our leading economic index was smaller than expected. Still, stocks in the US opened much lower, and for the day we're down about 1% on the Dow Jones index, and S&P and Nasdaq were off 1.3 and 1.6% respectively. We also saw oil fall more than $2, so we did see risk aversion despite what seemed to be okay economic data. In a look at the pound-dollar pair, we saw the pound sliding in today's trading until it found support near 1.66. That's about a 250 pip declined from its high in yesterday's session. So we undid the gains that we saw from Monday, and if we had a Fibonacci line plotted here, we can actually see that we fell down to the 123% retracement of this initial rally. If we take a look at this Fibo retracement from this low near 1.65 up to this high, we saw that we fell below both the 50 and 61.8% retracement areas, though we did rally back to the 61.8 area, and that's where we're finished our global session in today's trading. If we zoom out even a little bit further, we also saw a downward break of this downward sloping resistance trend line, and now we're retesting it here. The pound yen, meanwhile, which had been trading in very narrow ranges the last several sessions, broke down below the 1.4940 area and slid more than 200 pips down to 147.30. So this was our first sort of move in a while in this pair, and we tested our lows from November 3rd in today's trading. And to look at some UK data, we saw retail sales increase 0.4% in October, a figure that was slightly smaller than expectations, while the annual rate rose to 3.4%, which was the best level in 17 months. Here we have a graph of the annual year-on-year sales on the right, and we can see that the last 5 months have seen rather good figures following this very poor first quarter. So while the sales data was rather okay from the UK, we did have very poor public sector net borrowing figures for October. The government borrowed $11.4 billion, and its budget deficit for this October was £7.7 billion. These figures represent a deterioration of the government's finances, and it's going to put pressure on the government to try and rein in its spending in the months to come. It's also worrisome for agency ratings, because it's the debt for the UK could begin to be questioned. Here we're looking at the Australian dollar US dollar pair, and Aussie is one of those higher yielders, and with risk aversion very prominent in today's trading, we saw it fall all the way down to the 0.9130 area. We broke a upward sloping line of support that had connected our lows for this week right here around 0.9250, and our resistance came from this level on November 5th. So we had acted as resistance before. We broke it about 2 weeks ago, and then now we're retesting this 0.9150 area as support. So this is a 2-week low for the pair. The New Zealand dollar US dollar pair also had a sharp fall, and we see here that we had about 190 pip move from low to high in today's trading. Now, the New Zealand dollar's fall was highlighted by growing discontent in the country with the government's inability to control foreign exchange fluctuations and concerns about a strong New Zealand dollar, which could hamper New Zealand exports. In our final pair for today, the US dollar Canadian dollar pair extended its gains from late yesterday's trading until it reached close to the 1.07 area. We saw a break of a downward sloping resistance trend line that had connected these three highs right here at the 1.0580 area. If we plot a Fibonacci retracement of this move, we see that we had an initial resistance overnight at the 50% retracement area, and then our actual support for today and our high came at the 61.8 retracement of this move from 1.0850 down to 1.04. Going to look at some upcoming fundamental releases. The docket is going to be very light to end the week. Tonight we'll have the Bank of Japan having its interest rate decision, while overnight we just get Germany producer prices, and there are no key releases from the US or Canada tomorrow. So that will wrap up today's coverage of the Forex market. Again, for more analysis and videos, please do visit our site fxtimes.com. As always, thank you for watching and happy trading.